Hey guys, tonight we dive into something that's almost too simple to believe, yet it's the single question that Warren Buffett asks when evaluating any investment. You probably won't survive this deep dive without questioning everything you've ever thought about investments. So, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. And, as always, feel free to drop your location and the time in your neck of the woods. I'm curious where everyone's tuning in from tonight. Now, dim the lights, maybe turn on a fan for that soft background hum, and let's ease into tonight's journey together. This all starts with one question, a question so simple, it's almost maddening. Warren Buffett, the man who turned $10 into a multi-billion-dollar empire, doesn't spend his time analyzing complex algorithms or trying to predict the next big tech stock. No, he sticks to something far more elementary. The question he asks is, can you understand how this business makes money? It sounds like a no-brainer, right? But you'd be surprised how many investors, professionals included, fail to ask themselves this fundamental question. They dive headfirst into stocks and bonds, attempting to outsmart the market without fully understanding the underlying business. Buffett's genius lies in his focus on simplicity, and this question is the core of his strategy. If you can't answer that question clearly and without hesitation, he won't waste his time with it, and neither should you. The question might seem too obvious to even discuss, yet it reveals something profound about the way Buffett approaches investing. In a world where complex financial instruments and algorithms are constantly evolving, Buffett's strategy is rooted in the basics. He invests in businesses, not stocks. When you think about it like this, the stock market becomes a secondary concern to the business itself. This isn't about stock prices fluctuating on a daily basis or playing the market's short-term game. It's about owning a part of a business that you understand something that has real value, regardless of how the market behaves on a given day. Buffett believes that the stock price should reflect the underlying value of the business. If you can grasp the ins and outs of how a company operates, how it generates revenue, and how it competes in its market, you're miles ahead of most investors. Buffett often uses the metaphor of buying a business when he talks about investments. Imagine, for a moment, that you're not buying stock in Apple or Coca-Cola. Instead, think of yourself as buying the entire company. You're not just purchasing shares, you're investing in the people, the products, the future of that business. And to make an informed decision, you need to understand its operations from the inside out. That's the key. It's easy to get distracted by the glitzy, fast-paced world of Wall Street and high-tech startups. The media hypes up the next big thing, and everyone jumps in, hoping to ride the wave of a booming stock. But in Buffett's eyes, this is the equivalent of trying to predict the weather tomorrow. Sure, you can guess, but there's no real basis for that guess beyond the current conditions. And those conditions, whether they're favorable or unfavorable, can change in the blink of an eye. Instead, Buffett focuses on things that don't change as much: strong business models, consistent revenue streams, reliable management, and competitive advantages. If a company has these factors in place, then its stock price should, in theory, rise over time. But if you don't understand what drives that company's success, how can you expect to make the right calls about whether it's a good investment or not? Here's the twist. This question doesn't just apply to new investments. It's part of Buffett's ongoing process of reevaluating his current portfolio. Even after decades of success, he's always asking himself whether he fully understands how each of his holdings makes money. This ensures that every business he owns continues to meet his standard of clarity. If any company he invests in starts becoming too complex or unpredictable for him to comprehend, that's a red flag. Remember, Buffett doesn't need to be a genius. He just needs to understand the business inside and out. The power of this approach comes from its simplicity. Most people try to overcomplicate investing, convinced that they need to know every detail about every company. But Buffett knows that the more you try to understand every little detail, the more likely you are to lose sight of the big picture. By focusing on what's easy to understand, he's avoided costly mistakes and focused on companies with strong, sustainable businesses. His model isn't about beating the market, it's about finding reliable, understandable businesses that will perform well over the long term. Historians still argue whether Buffett's one-question philosophy is the reason he's outperformed the market for decades. or if it's simply his knack for finding the right opportunities. However, what's clear is that this question is at the heart of Buffett's success. It's his filter, his lens through which he evaluates all potential investments. But that's not all there is to it. While the question is critical, Buffett's investing style is multifaceted. He isn't just a stock picker, he's a savvy business owner, a financial tactician who looks beyond the numbers to the people running the businesses. So, now that you have a grasp of his key question, it's time to explore the philosophy that surrounds it. Now that you've got the core question that Warren Buffett uses to sift through countless investments, let's zoom out and explore a broader concept that underpins much of his strategy: simplicity. You might be wondering why simplicity is so essential in investing. After all, the stock market can feel like a complicated, high-stakes game where understanding complex metrics is a key to success, right? Well, that's exactly where Buffett stands apart. His success isn't about outsmarting the market with complex strategies, it's about keeping things simple. Let's break this down. Think about the sheer complexity of the financial world. Every day, thousands of new investment opportunities come and go. Analysts flood the airwaves with reports on intricate economic theories, complex financial models, and the next big thing that will change the world. If you get caught up in that noise, it's easy to lose focus. Buffett, however, focuses on simplicity as a guiding principle in his decision-making. He isn't trying to play a game of wits with the market. Instead, he seeks to find straightforward, understandable businesses that fit his criteria. This focus on simplicity doesn't just apply to the companies he invests in, it's embedded in his entire philosophy. There's a reason Buffett has said that the most important thing to do if you find yourself in a hole is to stop digging. It's a brilliant reflection of how simplicity helps to cut through the clutter and get straight to the heart of the matter. In investing, this translates into his approach of only investing in businesses that you can understand. He doesn't need to predict the next hot trend, and he's not interested in speculative bubbles. Buffett is about finding companies with clear, sustainable business models that make sense both today and in the long term. Take Coca-Cola, for example. When Buffett purchased shares in Coca-Cola, it wasn't because he was looking for a company on the cutting edge of technology or innovation. He invested in Coca-Cola because the business model was incredibly simple. It sold a product that people liked and could easily be replicated and scaled around the world. People drink Coca-Cola, and they'll probably keep drinking it for a long time. There's nothing fancy or complicated about that. The company's success was based on clear, repeatable actions. And that's what Buffett saw when he invested. Simplicity in investing also means understanding where a company fits in the world. Buffett is known for saying that if you can't explain how a company makes money in one sentence, then you don't understand the company well enough. This is where many investors go wrong. They'll throw their money into tech startups or emerging industries without fully grasping what the company does, how it operates, and where it's headed. In contrast, Buffett takes a step back and looks for businesses with clear, understandable, and predictable revenue models. It's not about jumping on the next big thing, it's about having a steady, reliable stream of income. And yet, simplicity doesn't mean that Buffett only sticks to basic businesses with zero innovation. He also looks for businesses that can continue to evolve and grow within their simple framework. The real genius of Buffett's approach lies in his ability to spot simple businesses with massive potential for growth. Take Apple, for example. On the surface, Apple might seem like just another tech company, but Buffett invested in it not because of its cutting-edge gadgets, but because of its strong brand, customer loyalty, and recurring revenue from its ecosystem of products and services. These factors made the business model easy to understand and stable, even in an ever-changing technological landscape. This brings us to another layer of Buffett's philosophy: staying within your circle of competence. Simplicity and competence go hand in hand. When Buffett talks about his circle of competence, he's referring to the idea that you should only invest in what you understand. And here's where simplicity really shines. If a business is simple, it's easier to understand and therefore, it's more likely to fall within your circle of competence. Many investors get burned because they overstep their boundaries, investing in businesses or sectors they don't fully understand. Whether it's biotech, cryptocurrency, or cutting-edge AI, these areas can be complex, unpredictable, and difficult to comprehend for someone who doesn't have deep expertise in them. Buffett, on the other hand, sticks to what he knows. He has a deep understanding of how businesses operate, what makes them profitable, and what signals to look for in order to assess their long-term viability. The beauty of simplicity is that it gives you clarity. When you understand a business, you don't need to worry about the day-to-day fluctuations in stock prices or the latest headlines. You can focus on the bigger picture, how the business operates, how it makes money, and whether it's positioned for sustainable growth. And that clarity allows you to make decisions based on fundamentals, rather than reacting to short-term market movements. Now, before we get too carried away with the idea of simplicity, let's pause for a moment to acknowledge something important. Simplicity doesn't mean you're guaranteed success. Understanding a business and investing in it for the long haul is no guarantee that it will perform well in the market. However, Buffett has learned that by sticking to what you understand and avoiding unnecessary complexity, you greatly increase your chances of success over time. His strategy isn't about gambling, it's about intelligently selecting businesses with solid, straightforward models and allowing them to grow at their own pace. Historians still debate whether Buffett's investment success is due to his straightforward approach or whether he's simply been lucky over the years. But there's no denying that the principles of simplicity, patience, and competence have allowed him to consistently make sound investments. And for anyone looking to replicate his success, there's no better place to start than by embracing the power of simplicity. So, as we move forward, remember that the next time you consider an investment, ask yourself, can I understand how this business makes money? If the answer isn't immediately clear, then it might be time to look for something simpler. After all, simplicity is where Buffett's genius lies, and it's exactly where the majority of investors go wrong. Now that we've explored the simplicity behind Warren Buffett's investment philosophy, let's dig a bit deeper into one of the most important aspects of his strategy, the circle of competence. You may have heard this term before, but its significance in Buffett's approach can't be overstated. Understanding your circle of competence doesn't just help you avoid bad investments, it's the bedrock on which Buffett's entire strategy is built. And, spoiler alert, it's a lot simpler than it sounds. At its core, the circle of competence is about knowing what you're good at, and more importantly, what you're not. Buffett has often said that the key to investing success is understanding your strengths and sticking to them. If you're an expert in one area, it's tempting to branch out and try your hand at new, unfamiliar fields. But Buffett, with his decades of experience, knows that this is a surefire way to get into trouble. It's easy to get lured by the promise of a hot new trend or a flashy startup. But if you don't fully understand how that business works, you're risking your financial future. Imagine for a moment that you're a doctor. You're highly skilled in your medical field, and you've spent years honing your craft. But one day, someone approaches you and asks you to perform surgery on an alien species from another planet. Sounds like a tough sell, right? You might know a lot about human anatomy, but dealing with a completely unknown species, that's beyond your circle of competence. The same principle applies to investing. Buffett applies this idea across all of his investments. He's built his wealth by sticking to industries and companies that he understands deeply. He isn't out there trying to get in on the next big tech IPO or hedge his bets on some new crypto token. Instead, he sticks to businesses that fit within his circle of competence, companies that he can analyze and evaluate with confidence. If he doesn't understand the underlying business model, he won't invest in it. It's that simple. But here's the tricky part. Everyone has a different circle of competence. Buffett's circle may include industries like insurance, consumer goods, and railroads, while someone else might have expertise in technology, pharmaceuticals, or energy. The key is to recognize where your strengths lie and focus your investments in those areas. Just because a stock is performing well or because an industry is trending doesn't mean it's right for you. The circle of competence isn't about being an expert in everything. It's about being the expert in the areas where you have the most knowledge and understanding. A common mistake many investors make is trying to chase hot trends without fully grasping the businesses they're betting on. This often leads to buying into companies that are flashy but lack the stability and long-term viability of more traditional businesses. Buffett, on the other hand, has often said that he would rather invest in a simple business that he understands than a complex one that he can't fully wrap his head around. This wisdom applies not just to stocks, but to other investments as well, whether it's real estate, commodities, or private equity. Sticking to your circle of competence is a principle that's just as valuable across the board. The brilliance of this strategy lies in its simplicity. If you understand the business, you're more likely to be able to predict its future trajectory. And when you're predicting the future, it's a lot easier to make rational decisions based on the data at hand, rather than emotional impulses or market hype. For Buffett, sticking to his circle of competence has allowed him to sidestep the types of risky, speculative investments that can derail many investors. But let's be clear here. The circle of competence isn't about being a know-it-all. In fact, one of Buffett's most famous quotes is, "I don't try to jump over 7-foot bars. I look around for 1-foot bars that I can step over." This quote perfectly encapsulates his investment strategy. Buffett isn't trying to beat the market with complex, high-risk strategies. He's simply looking for businesses that fit neatly into his understanding of the world, ones that he knows he can analyze with confidence and predict with a reasonable degree of certainty. That's how he's built his wealth over time, by focusing on what he knows best. Here's another layer to consider. Your circle of competence can grow over time. Buffett didn't start out understanding the ins and outs of every business sector. He got there by spending years learning, reading, and developing a deep understanding of the industries he's invested in. The key is being patient and consistent in expanding your knowledge. Over time, your circle of competence will naturally expand as you accumulate more experience and expertise. But Buffett warns, this doesn't mean you should take on investments just because you've learned a new concept or strategy. Just because you've brushed up on the basics of a new industry doesn't mean it's time to jump in. You need deep, actionable knowledge to make informed decisions. Historians still debate the origins of the circle of competence idea. Some argue it's a modern investment technique, while others claim it's simply a repackaging of an age-old investment wisdom. Regardless of its origin, it's one of the key elements that have made Buffett's strategy so successful over the years. And for those looking to replicate his success, the circle of competence isn't a rule to be ignored. It's the foundation upon which all his investments are built. So, the next time you consider investing in a stock or business, ask yourself, do I understand how this business operates? Can I explain its revenue model in simple terms? If the answer is no, then it might be time to move on to something within your circle of competence. The point isn't to be an expert in everything. It's to be an expert in a few areas and invest with confidence. That's the true power of the circle of competence. Now that we've explored the importance of staying within your circle of competence, let's shift gears and look at one of the most fundamental principles in Warren Buffett's investment philosophy: long-term thinking. This is where Buffett really sets himself apart from the majority of investors who are obsessed with short-term gains. If there's one thing that's at the heart of Buffett's success, it's the mindset that the best investments are the ones that will grow over time, not those that deliver quick, flashy results. You've probably heard it before. Time is your friend. Impulse is your enemy. This could be Buffett's motto when it comes to investing. The stock market may fluctuate like a roller coaster, but the key to making money is to stay on the ride, stay calm, and let time do the heavy lifting. And when you think about it, this idea is incredibly simple. It's not about reacting to every market movement. It's about holding investments long enough for them to reflect their true value. Buffett's long-term philosophy can be traced all the way back to his early days as an investor. Unlike many investors who were looking for short-term profits or trying to time the market, Buffett understood that wealth is built over time through compound interest and steady growth. The companies he invests in are chosen with a focus on the future, not just the present. He isn't trying to cash out after a few months. He's investing in businesses he believes will thrive over the decades. Let's put this into perspective. Imagine you're looking at two companies. One company is experiencing explosive growth, with its stock price skyrocketing every few weeks. The other is more stable, with steady, reliable growth over the years. Most investors would flock to the first company because they want to make a quick buck. But Buffett looks at the second company and sees long-term potential. The short-term fluctuations in price don't faze him. Instead, he asks, is this business likely to perform well for the next 20, 30, or 40 years? If the answer is yes, that's where his money goes. Why does this long-term perspective matter so much? Well, the stock market isn't always rational. In the short term, stock prices are influenced by all sorts of factors: news, rumors, market trends, and even investor emotions. It's easy to get swept up in the volatility and sell at the wrong time, often missing out on the long-term benefits of holding an investment through its ups and downs. Buffett, however, has mastered the art of ignoring the noise. He's focused on businesses that are fundamentally sound, and he knows that the market will eventually recognize their true worth. Let's think about one of Buffett's most famous investments, Coca-Cola. When Buffett bought shares in Coca-Cola in the late 1980s, it wasn't because he thought the company was going to have a stellar year or even a great few quarters. No, he bought Coca-Cola because he saw a timeless business model. People were always going to drink soda, and Coca-Cola was an iconic brand with a global reach. The business had strong fundamentals, and that's what mattered to Buffett. Over time, Coca-Cola's stock price has performed exceptionally well, but it wasn't an overnight success. It was steady growth driven by a solid business foundation. Buffett was willing to wait for that growth, and in the end, it paid off massively. Historians still argue about the true impact of Coca-Cola's popularity in the 1980s. Was it just a good period for the soda industry? Or was it a fundamental shift in consumer behavior that laid the groundwork for Coca-Cola's global dominance? Whatever the case, Buffett's investment was a bet on brand strength, consumer loyalty, and a business model that had stood the test of time. The key takeaway here is that Buffett didn't focus on the short-term hype. He focused on the long-term value. But long-term thinking isn't always easy. In the fast-paced world we live in, everyone is in a rush to see results. The 247 news cycle, social media updates, and constant market fluctuations can all pressure investors to make quick decisions. But Buffett's strategy is different. He waits for the right opportunities and invests in companies with staying power, as he said countless times. The stock market is a device for transferring money from the impatient to the patient. This is a perfect reflection of his approach. While others are panicking and selling off their stocks during market downturns, Buffett is calm, collected, and patiently waiting for his investments to grow. He knows that true value takes time to reveal itself. This long-term approach is not just about financial growth, it's also about mental growth. Buffett has often said that one of the best parts of investing is being able to let time and compound interest work in your favor. When you're not constantly looking over your shoulder at every market dip, you free yourself from stress and worry. You can sit back and watch your investments gradually gain value, knowing you've chosen the right businesses to bet on. It's a psychological benefit that many investors miss out on when they're obsessed with chasing quick profits. It's also worth noting that this approach works best when you invest in businesses you believe in. Buffett's long-term strategy isn't about buying and holding any stock for decades. It's about buying into companies with strong, proven business models. He's not interested in betting on a company just because it's trending upward in the short term. He wants businesses that will continue to thrive for the next few decades. That's why he often steers clear of high-tech startups and instead focuses on traditional industries that have stood the test of time. Buffett's long-term perspective has paid off in spades. His holding company, Berkshire Hathaway, has consistently outperformed the market, not by jumping on the latest trends, but by sticking with businesses that have a solid foundation and strong future potential. And as you think about your own investment strategy, ask yourself, am I focused on long-term value? Or am I getting swept up in short-term excitement? Remember, wealth doesn't come from trying to outsmart the market. It comes from investing in things that have lasting, sustainable value. Having delved into the significance of long-term thinking, we now shift our focus to another key factor in Warren Buffett's approach: the importance of trust in management. For Buffett, investing isn't just about numbers and charts. It's also about the people running the company. After all, a business is only as strong as the leadership that guides it. When Buffett evaluates a potential investment, one of his most critical considerations is whether or not he trusts the people behind the business. It may sound simple, but it's crucial. Trusting the management team is non-negotiable. Buffett has said on multiple occasions that he's willing to pay a premium for a company with excellent management. It's not about looking for leaders with the highest IQ or the most innovative ideas. Instead, he focuses on people with integrity, transparency, and a long-term vision. This trust in leadership can make all the difference, as a good management team can take a solid business model and elevate it to extraordinary heights, while bad leadership can destroy even the most promising companies. Let's consider one of Buffett's most iconic investments, See's Candies. Buffett was drawn to the company not only because it had a fantastic product and a solid business model, but also because he had immense trust in the management team. The company was led by a husband and wife team who were committed to running the business with a focus on quality, efficiency, and customer satisfaction. Buffett didn't need to be convinced by flashy business projections or bold promises. What mattered to him was that the people running the company were transparent, ethical, and had their priorities in order. This emphasis on trust extends beyond just the management's competency. It's about their ability to think long-term. Buffett prefers management teams that aren't swayed by short-term pressures to increase quarterly earnings at the expense of long-term growth. The leaders he trusts are those who focus on building sustainable businesses, rather than seeking immediate profits. And this is a major reason why Buffett has been so successful over the years. He invests in companies that are in the hands of people who share his long-term vision and values. Now, trusting management isn't as easy as it sounds. How do you know if a company's leadership is truly trustworthy? Well, Buffett often looks for clues in a company's history. Have the executives consistently made smart, ethical decisions? Do they have a reputation for honesty and transparency? He also looks at their track record. Have they weathered difficult times and still managed to uphold their integrity? If the answer is yes, that's a good sign that the management team is someone he can trust with his investment. But trust isn't built overnight. In fact, Buffett is known for his patient approach when it comes to understanding management. He doesn't rush into an investment simply because the numbers look good. He takes the time to get to know the leaders of the company, to understand their values, and to see how they handle both success and failure. Buffett values consistency in management, and he appreciates leaders who act with a sense of responsibility toward their employees, customers, and shareholders. This focus on trustworthy leadership isn't just a feel-good concept. It's a practical matter. When the people at the top of a company are trustworthy, they're more likely to make decisions that benefit the business in the long run. They're less likely to make impulsive, short-sighted choices that can harm the company's reputation or bottom line. Buffett knows that great companies don't just thrive because of their products or services. They thrive because they're led by great people. But there's another layer to this trust-based philosophy. Buffett also values companies where the management has a significant personal stake in the business. This aligns the interests of the management team with those of the shareholders. When leaders have their own money invested in the business, they are more likely to make decisions that will benefit the company over the long term. This ensures that both the company and its investors are pulling in the same direction. This is particularly important when you consider the ownership structure of many companies Buffett invests in. He doesn't just buy stocks in random companies, he's often buying a substantial portion of the business, sometimes to the point of taking a controlling stake. This gives him a unique ability to influence the management and ensure they stay on track. Buffett has said that he likes to invest in businesses where he can work with management directly, rather than just being a passive shareholder. Trust in management doesn't just mean relying on others, though. Buffett himself has cultivated a reputation as a highly ethical and transparent leader. The trust he has built with his shareholders over the years is a direct reflection of his own management style. He's known for his candid annual letters to shareholders, where he discusses the company's successes and failures openly, without sugarcoating the truth. This openness has earned him immense respect within the business world. And it's one of the reasons why he's been so successful in attracting talented managers to his various ventures. For Buffett, investing is about more than just financial metrics. It's about investing in people. When the right management team is in place, it can transform an average business into a great one. The best management teams know how to adapt to changing market conditions, but they do so while staying true to the core principles that made the business successful in the first place. They don't chase after the latest trend or gimmick. They stay focused on their long-term vision. Historians still debate the exact formula for Buffett's success. But one thing is clear. The people behind the businesses he invests in play a huge role. Without trustworthy, competent, and long-term focused leadership, even the best business model can falter. And that's why, when Buffett is evaluating an investment, the leadership of the company isn't just an afterthought. It's a critical piece of the puzzle. As we move forward, keep in mind that your investment journey shouldn't just be about picking stocks based on the numbers. It's also about understanding the people behind the companies. Are they trustworthy? Do they have a long-term vision? Do they care about building something sustainable? If you can answer these questions, you're one step closer to finding investments that align with Buffett's principles. Moving from the importance of trusting management, let's now turn our attention to a cornerstone of Buffett's investment strategy: the role of business fundamentals. While many investors get swept up in stock price fluctuations or market trends, Buffett remains steadfast in his belief that the true value of a company lies in its core business fundamentals. These are the driving forces that power a company's profitability and long-term success, and they are, without a doubt, the bedrock on which Buffett builds his investment decisions. When Buffett evaluates a company, he doesn't just look at its stock price or immediate earnings. Instead, he focuses on the underlying business, how it makes money, how it operates, and whether its fundamental financial health is strong enough to sustain long-term growth. This includes a deep dive into everything from profit margins to cash flow, and from debt levels to competitive advantages. The numbers are not just numbers to Buffett, they are a reflection of the company's ability to thrive over time. One of the most important aspects of business fundamentals for Buffett is consistency. He isn't looking for a company that will have a great year and then fade away. Instead, he looks for companies that have a history of consistent earnings, stable cash flows, and the ability to weather economic downturns. A company that has weathered tough times and still managed to deliver solid financial results is much more appealing to Buffett than one that has had sporadic successes and failures. Stability is key. Companies that can consistently produce results are far more likely to continue doing so in the future, making them prime candidates for Buffett's portfolio. For example, take Berkshire Hathaway, Buffett's own company. If you look at the company's financials, you'll see that it's not just about individual investments. It's about a portfolio of businesses that are fundamentally strong. These companies generate reliable cash flow, have manageable levels of debt, and operate in industries with long-term potential. When Buffett talks about investing in great businesses, he's not just talking about looking for companies with the most innovative products. He's talking about finding businesses that are built to last, businesses that can deliver steady, predictable returns year after year. Buffett's focus on business fundamentals also includes looking for companies with strong competitive advantages, or what he calls a moat. The idea of a moat is simple. It's the barrier that protects a company from its competitors. If a business has a strong moat, it means that it has something unique, whether it's a brand, technology, customer loyalty, or something else that gives it a sustainable edge over its competitors. A company with a solid moat can fend off competition and continue to grow, even in the face of market disruptions. A classic example of a business with a strong moat is Coca-Cola. When Buffett invested in Coca-Cola, he wasn't just buying into a beverage company, he was investing in a global brand with a loyal customer base and an extensive distribution network. Coca-Cola's moat is its brand strength, its consumer loyalty, and the economic scale that allows it to dominate the global beverage market. Even in the face of new competitors, Coca-Cola's moat allows it to maintain its position as a leader in the industry. This is exactly the type of company Buffett looks for, one that has a defensible position and a strong, durable market share. However, Buffett doesn't just look for businesses with strong fundamentals. Today, he's also interested in the future prospects of those businesses. A strong business today doesn't necessarily guarantee success in the future. For this reason, Buffett places a great deal of emphasis on predicting future cash flows and the company's ability to adapt to changing market conditions. He seeks businesses that not only have solid financials today, but also have the ability to thrive in the future. This is where Buffett's focus on management comes into play. A company's management team plays a crucial role in ensuring that the business fundamentals remain strong and that the company can adapt to future challenges. A great company with strong fundamentals can quickly falter if its leadership doesn't know how to navigate changing market conditions. That's why Buffett is so meticulous about trusting the management of the businesses he invests in. It's one thing to have strong fundamentals, but it's another thing entirely to have the right people leading the charge toward continued success. In addition to cash flow and profitability, Buffett also closely examines a company's debt levels. He's known for avoiding businesses that are overly leveraged or that rely too heavily on debt to fuel growth. High levels of debt can put a strain on a company's financials, especially if interest rates rise or economic conditions worsen. Buffett prefers companies with strong balance sheets, those that have manageable debt levels and the ability to generate enough cash flow to pay off obligations without overextending themselves. This focus on financial health ensures that Buffett's investments are built on a solid foundation, without the risk of being crippled by excessive debt. But how do you, as an investor, replicate this focus on business fundamentals? The first step is to educate yourself about the key financial metrics that define a strong business. This includes looking at things like revenue growth, profit margins, return on equity, and free cash flow. These metrics give you a clear picture of a company's financial health and its ability to generate sustainable profits. It's not enough to look at a company's stock price or short-term earnings. True investors look at the long-term fundamentals that drive the business. Historians still debate the impact of Buffett's preference for fundamental analysis versus technical analysis, the school of thought that focuses on price charts and market trends. However, what's clear is that Buffett's approach has worked wonders for decades. By focusing on the fundamentals, he's been able to make intelligent, long-term investments that have outperformed the broader market. And as you consider your own investment strategy, it's worth asking yourself, are you focusing on the company's underlying business, its cash flow, profitability, and market position, or are you getting distracted by stock price fluctuations? In the end, Buffett's success isn't about luck. It's about understanding the fundamentals that drive real, long-lasting value. By investing in companies that are strong at their core, he's been able to build an empire that thrives in both good times and bad. As you look at potential investments, remember, it's the fundamentals that matter most, and they are the foundation upon which Buffett's fortune has been built. Now that we've explored the critical importance of understanding business fundamentals, let's turn our attention to a concept that's been central to Warren Buffett's investment success, the margin of safety. This principle, which has been a cornerstone of his strategy for decades, serves as a crucial safety net in the unpredictable world of investing. While many investors are content to take on high levels of risk in hopes of big rewards, Buffett has always advocated for a more cautious, calculated approach. The margin of safety is simple. It's the cushion between a company's intrinsic value and its current market price. In essence, it's about buying stocks or businesses at a price that is significantly lower than their true value, giving you room to absorb any unexpected risks or market downturns. This buffer protects investors from errors in judgment, unforeseen changes in the market, or any external events that might negatively impact the company's value. The bigger the margin of safety, the less risk there is to the investor, and the higher the potential for profit. For example, let's say that you're evaluating a company, and after carefully analyzing its financials, you determine that its intrinsic value, its true worth, is $100 per share. If the stock is currently trading at $120 per share, you're paying a premium for it, and there's less room for error. On the other hand, if the stock is trading at $70 per share, then you've built yourself a nice margin of safety. In this scenario, even if things don't go perfectly for the company, you've still bought it at a price that allows for potential gains. Buffett has often said that he doesn't mind missing out on a great opportunity if it means avoiding a potential loss. For him, preserving capital is just as important as making gains. By incorporating a margin of safety, he can reduce the likelihood of catastrophic losses, even when the market behaves unpredictably. In fact, some of his most successful investments, like Geico and Coca-Cola, were purchased when their prices were well below their intrinsic values, providing him with a significant cushion against risk. Let's break this down with a historical example. Geico. In the 1970s, Buffett invested in Geico when the company's stock was trading at a relatively low price, based on its true value. Geico had strong fundamentals, a competitive advantage, a solid business model, and predictable cash flow, but its stock was undervalued due to temporary market conditions. By purchasing shares at a discount, Buffett was able to acquire a significant margin of safety. As the company's true value became more recognized over time, the stock price soared, and Buffett's investment paid off handsomely. This is the power of the margin of safety. It gives you a cushion against the inevitable mistakes or market shifts that can occur along the way. But how do you calculate the margin of safety for yourself? The first step is to develop a clear understanding of a company's intrinsic value. This involves digging deep into the company's financials, understanding its growth prospects, and evaluating its competitive advantages. Once you have a solid grasp on its value, you can compare that to its current market price. If the stock is trading at a significant discount to its intrinsic value, then you're in the sweet spot for the margin of safety. If it's trading above its intrinsic value, then you're taking on more risk. The margin of safety doesn't just apply to stocks. It can be applied to virtually any type of investment, from real estate to bonds to private equity. The key is to always make sure that the price you're paying for an asset is well below its true worth, so that you can weather any market storms that may come your way. For Buffett, this isn't about finding the next hot stock. It's about finding investments that are priced below their true value, giving you the best chance for a profitable outcome while minimizing risk. But let's not forget, the margin of safety is not about predicting the future. No one can know exactly what will happen in the market, or how a company will perform over time. Even Buffett makes mistakes from time to time, and not every investment he makes turns into a winner. However, by focusing on companies with a strong margin of safety, Buffett reduces the chances of those mistakes turning into catastrophic losses. This principle provides an important cushion that helps him sleep at night, knowing that even if things don't go according to plan, he's still protected by the gap between price and value. The beauty of the margin of safety is that it gives you the confidence to hold on to investments through market turbulence. If you've bought a company at a price significantly lower than its intrinsic value, you're more likely to stick with it when the stock price takes a temporary dip. You know that the company is worth more than what the market is currently valuing it at. So you're less likely to panic and sell during times of market volatility. This is a key part of Buffett's long-term strategy. He doesn't get rattled by short-term fluctuations because he knows that the underlying value of his investments will shine through over time. Historians still argue about the extent to which the margin of safety concept is unique to Buffett, or whether it has been a widely accepted principle among investors throughout history. But what's undeniable is that Buffett has mastered this strategy, making it a cornerstone of his approach. The margin of safety is the difference between making an educated, calculated bet and gambling on uncertain outcomes. It's the safeguard that allows Buffett to make long-term investments without worrying about unpredictable market forces. So, as you consider your own investments, remember the margin of safety? It's not about buying the latest trend or chasing after high returns. It's about minimizing risk and ensuring that you're paying a fair price for the businesses you invest in. With a solid margin of safety, you'll be better positioned to weather the storms of the market and come out ahead in the long run. After all, the goal is to preserve your capital first and foremost, and the margin of safety is the shield that protects you. Now that we've delved into the concept of the margin of safety, it's time to explore one of Warren Buffett's greatest beliefs in investing: the magic of compounding. If you've ever heard Buffett talk about investing, you've probably heard him rave about compounding. In fact, he's called it the eighth wonder of the world. This simple yet powerful concept has been the backbone of his wealth-building strategy, and understanding it is essential for anyone looking to achieve long-term financial success. Let's start with a fundamental truth about investing. Compounding is the process of earning returns on your initial investment, as well as on the returns that accumulate over time. In other words, compounding allows your money to grow at an accelerating rate, because you're not just earning interest on your principal, you're earning it on the interest itself. The longer you let this process work, the more it snowballs, eventually turning modest investments into huge sums of money. Warren Buffett has famously said that the secret to his success is simply having started early and letting compounding work its magic. The earlier you start investing, the more time your money has to grow exponentially. This is why Buffett is such a big advocate for investing early. and why he's often shared stories of how his wealth began to grow at a significant rate only after many years of disciplined investing. Compounding, when given enough time, can transform even small investments into substantial sums. For example, let's imagine you invest $10, 0 at an annual return rate of 8%. At first, your returns might seem modest. After the first year, you'll have earned $800 in profit. But as the years go on, those returns start to stack on top of each other. By year 10, your investment has grown to about $21.589, a significant increase. All thanks to compounding? But it doesn't stop there. In another 10 years, your $21.589 grows to over $46. No. And over the course of 30 years, it would grow to more than $100. No. This gradual accumulation of wealth is the magic of compounding in action. But here's the thing, compounding only works if you leave your investment untouched for a long period of time. The more time you allow for your money to grow, the more powerful the compounding effect becomes. Buffett has always been a proponent of buying great companies and holding on to them for years, sometimes even decades. He doesn't jump in and out of stocks based on short-term market fluctuations. Instead, he lets the magic of compounding do its thing, and he watches as his investments grow over time. It's worth noting that Buffett's favorite example of compounding is his own investment in Berkshire Hathaway. When he first took control of the company, it was a struggling textile manufacturer. But instead of focusing on short-term gains, Buffett focused on the long-term potential of the company. Over time, he took the profits from Berkshire's operations and reinvested them into other companies, compounding those returns year after year. Now, Berkshire Hathaway is one of the most successful companies in the world, with a market cap in the hundreds of billions of dollars. All of this success is the result of steady, long-term compounding. But compounding doesn't just apply to companies, it's also relevant to individuals. When you invest wisely, and over the long term, you're able to reap the benefits of compounding just as Buffett has. For the average investor, this means focusing on low-cost index funds, diversified portfolios, and buy-and-hold strategies that allow your investments to grow over time. The key is to stay disciplined and not get distracted by short-term volatility. Remember, compounding is a marathon, not a sprint. In fact, Buffett himself recommends the power of patience when it comes to investing. In his words, the stock market is a device for transferring money from the impatient to the patient. The impatient investor who constantly buys and sells is missing out on the power of compounding. The patient investor, on the other hand, lets their investments grow, and over time, their wealth begins to snowball. But here's an important reminder. Compounding works best when you focus on quality. The companies you invest in need to have strong fundamentals, a solid business model, and a clear path for growth. Otherwise, the magic of compounding won't work as effectively. Investing in businesses that are fundamentally sound, that have a competitive advantage, and that are led by trustworthy management teams is crucial to ensuring that the process of compounding can take place successfully. This is why Buffett often advises against speculative investments, those that may offer high short-term returns but lack the underlying strength to sustain long-term growth. The key to compounding is finding investments that you believe in, that have a reliable track record, and that will continue to generate profits for years to come. When you combine those elements with the power of compounding, the results can be extraordinary. Historians still argue whether compounding is the sole reason behind Buffett's wealth or whether other factors, like his keen investment instincts, deserve more credit. But there's no doubt that compounding has been a central theme throughout his entire career. It's a simple, yet powerful concept that has allowed him to build an empire of wealth that spans decades. So, as you think about your own investment journey, remember that time is your best ally. The sooner you start investing, the more time your money has to compound. Focus on companies with strong fundamentals, and don't get discouraged by the inevitable ups and downs of the market. If you remain patient and disciplined, the magic of compounding will take care of the rest, gradually building your wealth over time. It's not about chasing quick profits, it's about letting your money work for you in the background, quietly growing and compounding to create long-term wealth. As we dive deeper into Warren Buffett's investment philosophy, we now come to another crucial element: emotional control. If you've ever been swept up in the rush of a stock market boom or panicked during a sudden downturn, you know how hard it can be to keep your emotions in check. Yet, this is one of the defining qualities of Buffett's success: his ability to stay calm when others are losing their heads. Emotional control is a skill that every investor needs to cultivate, and it's one that Buffett has mastered over the decades. Buffett has often said that the market is a voting machine in the short term and a weighing machine in the long term. What he means by this is that in the short run, stock prices are largely driven by emotions and speculation. People panic or get overly optimistic, causing prices to fluctuate wildly. In the long run, however, the true value of a company is what matters most, and the market eventually corrects itself. In this way, emotions can lead investors astray, causing them to buy high and sell low. But by keeping his emotions under control, Buffett has been able to make rational, long-term decisions that have consistently paid off. When the market goes through a rough patch, many investors panic. They sell their holdings in a frantic attempt to stop the bleeding, often locking in losses. But Buffett doesn't panic. Instead, he sees volatility as a buying opportunity. He's famously said, "Be fearful when others are greedy, and greedy when others are fearful." When the market is in a state of fear, prices drop, and that's when Buffett swoops in. He's not afraid of market downturns. He sees them as temporary blips in the grand scheme of things, providing opportunities to acquire solid businesses at discounted prices. But how does he maintain this level of calm? A big part of it is his unwavering belief in the long-term value of the businesses he invests in. Buffett's strategy isn't about trading stocks based on the latest headlines or market news. It's about buying great businesses and holding on to them for the long haul. When you invest in companies with strong fundamentals, a competitive moat, and trusted leadership, you can afford to take a long-term view. Instead of reacting to every market movement, you can focus on the bigger picture, understanding that the true value of your investments will ultimately shine through. Another important aspect of emotional control is avoiding herd mentality. In the world of investing, it's easy to get caught up in the emotions of the crowd. When everyone is buying, it feels good to join in. When everyone is selling, it feels safer to get out. But as Buffett points out, this is the exact wrong way to invest. Herd mentality leads to irrational decision-making, driven by fear or greed. The key is to do the opposite of what the crowd is doing. If the market is panicking and stocks are being sold off, that's when Buffett starts buying. Conversely, if everyone is riding high on a bubble, he stays on the sidelines. Buffett's emotional control also extends to his ability to avoid overconfidence. Many investors, especially those who've experienced a few successful trades, can get caught up in the belief that they have the market figured out. They think they can time the market, predicting the next big move. But Buffett knows that this is a dangerous mindset. No one can predict the future with absolute certainty, and trying to do so can lead to devastating losses. Instead of relying on gut feelings or market predictions, Buffett relies on sound analysis and a rational, methodical approach. He invests in businesses he understands and trusts, and he stays disciplined in his decision-making, even when the market is telling him to do otherwise. So, how can you apply Buffett's emotional control to your own investing strategy? The first step is to develop a long-term mindset. If you're in the market for quick profits, you're more likely to get caught up in the ups and downs of daily market fluctuations. But if you're focused on long-term growth, you'll be able to weather market storms without panic. One of the best ways to build this mindset is to invest in businesses that you understand and believe in. When you truly understand the underlying value of a company, it's much easier to stay calm when the market gets jittery. Another key component of emotional control is to ignore the noise. The media, analysts, and even social media are constantly talking about the latest trends, news, and market fluctuations. It's easy to get distracted by all the chatter. But as Buffett often says, the best way to stay focused is to tune out the distractions. Instead of obsessing over every market move, focus on your long-term goals and keep your attention on the businesses you've invested in. When you filter out the noise, you'll be able to make decisions that are grounded in reality, not driven by emotion. Buffett's emotional control also ties into his ability to stick to his principles. Regardless of the market's direction, during times of market euphoria, it can be tempting to abandon your strategy and follow the crowd. But Buffett doesn't succumb to this temptation. He sticks to the basics, investing in businesses with strong fundamentals, clear value, and competent leadership. In times of market panic, he doesn't let fear drive his decisions. He remains patient, sticking with his long-term vision and staying confident in his investments. Historians still debate the true psychological traits that have made Buffett so successful. Some argue that his emotional control is a product of his personality, while others believe it's a result of years of discipline and experience. Regardless of the reason, there's no doubt that Buffett's ability to stay calm in the face of market chaos has played a pivotal role in his success. For investors looking to follow in his footsteps, emotional control is not just a skill, it's a mindset. So, the next time the market takes a dip, or you feel the urge to make a knee-jerk decision, remember Buffett's advice: be patient, stay disciplined, and let your investments grow over time. If you can maintain emotional control, you'll be better equipped to handle whatever the market throws your way, and you'll put yourself on the path to long-term success. Now that we've covered the importance of emotional control, let's shift gears and talk about one of the most essential principles in Warren Buffett's approach to investing: the value of patience. In today's world, everything moves at lightning speed. From instant news updates to on-the-spot stock trading, it seems like we're all in a rush to make quick decisions and achieve rapid results. But Buffett has always emphasized the power of waiting, a lesson that is crucial for anyone looking to achieve long-term success in the market. The value of patience can be seen in Buffett's very approach to investing. While most investors are caught up in the frenzy of daily stock price movements, trying to buy low and sell high within short time frames, Buffett's strategy is rooted in buying great companies and holding on to them for years, even decades. In his own words, "Our favorite holding period is forever." This simple yet profound statement underscores the core of Buffett's investing philosophy. Buy businesses you believe in and let them grow over time. Buffett's success isn't a result of making hundreds of trades in a year, trying to time the market. Instead, he's been able to build massive wealth by focusing on businesses with solid fundamentals and holding on to them through thick and thin. He doesn't get rattled by market volatility or short-term price movements. He knows that over time, the true value of his investments will shine through. Patience is a critical part of Buffett's strategy because it allows time for compounding. Compounding doesn't happen overnight. It requires time to work its magic. The longer you let your investments grow, the more they benefit from compounding. But if you're constantly buying and selling, trying to chase quick profits, you miss out on the exponential growth that comes from long-term investing. The power of compounding lies in time, and Buffett understands this better than anyone. By holding his investments for the long haul, he's been able to let his money grow steadily, and the results have been extraordinary. Let's consider the example of American Express, one of Buffett's most successful investments. When Buffett purchased shares in American Express, the company was dealing with a major scandal involving its salad oil business. At the time, many investors were quick to sell their shares, fearing the company's reputation had been irreparably damaged. But Buffett saw something others didn't. The core of the business was strong. He believed that American Express had the potential to recover and grow over time. Instead of selling, Buffett held on to his shares, and over the years, the company rebounded, eventually becoming one of the best-performing stocks in his portfolio. This is a perfect illustration of the power of patience in investing. Buffett's willingness to wait out the storm allowed him to capitalize on American Express's recovery. Had he sold during the crisis, he would have missed out on the incredible long-term growth that followed. Instead, his patience paid off, and he earned massive returns on his investment. It's important to note that Buffett's patience isn't about sitting idly and doing nothing. Patience in his context means waiting for the right opportunities. He doesn't just buy stocks at random and hold them forever. He is very selective in the companies he invests in. His patience is based on the belief that over time, businesses that are fundamentally strong will reward their shareholders. And, most importantly, he waits for those businesses to be priced at an attractive value before he buys. In a way, patience means discipline, not rushing into an investment just because it's popular or trending, but waiting for the right opportunity at the right price. For many investors, however, patience is one of the hardest qualities to master. It's easy to get caught up in the excitement of the market or the desire to make quick profits. When you see your friends or colleagues raving about the latest hot stock, It can be tempting to jump in and try to cash in on the action. But Buffett's success comes from doing the opposite, staying focused on the long-term potential of his investments and ignoring the noise of short-term market fluctuations. One way to cultivate patience in your own investing approach is to set long-term goals. Instead of constantly checking the stock market and worrying about daily price movements, focus on the bigger picture. Ask yourself, where do I want my investments to be in 5, 10, or 20 years? By shifting your focus to long-term objectives, you'll be better able to ignore short-term distractions and stay patient in the face of market volatility. Another way to practice patience is to invest in businesses you believe in. When you understand a company's value, its business model, and its growth prospects, it becomes much easier to hold on to your investment for the long run. The more confident you are in the strength of the business, the less likely you are to be swayed by short-term market movements. Buffett has often said that he only invests in businesses he understands and believes in. When you have that level of conviction, patience comes naturally. Patience also means sticking to your principles. In times of market euphoria, it can be tempting to chase the latest trends. But Buffett's strategy is to stay grounded in his investment philosophy. He avoids getting caught up in speculative investments or risky ventures, and instead focuses on businesses with a clear, sustainable competitive advantage. Even when the market seems to be moving in one direction, Buffett stays true to his principles, trusting that his long-term strategy will pay off in the end. Historians still debate whether Buffett's emphasis on patience is the key to his success, or if it's his ability to identify great companies at the right time. However, what's clear is that his long-term approach has been instrumental in building his incredible wealth. By focusing on quality companies, avoiding the temptation of short-term speculation, and practicing patience, Buffett has achieved sustained success over decades. As you think about your own investment strategy, remember that wealth is rarely built overnight. It takes time, discipline, and the willingness to wait for the right opportunities. If you can master the art of patience, you'll put yourself on the path to financial success, just as Buffett has done for over 50 years. Now that we've touched on the value of patience, let's delve into a concept that might seem counterintuitive to many investors: the power of focus. In an age where diversification is often seen as the holy grail of investing, Buffett's approach stands out as somewhat unconventional. While most investment advisors recommend spreading your money across a wide range of assets to mitigate risk, Buffett has built his empire by concentrating his investments in a relatively small number of businesses. This focus on quality over quantity has been a key element of his long-term success. The logic behind this is simple. By concentrating your investments in a few high-quality companies, you can allocate more time and energy to understanding them deeply. Rather than spreading yourself thin across dozens of stocks, you're able to dive deep into the financials, business models, and competitive advantages of each company you invest in. This gives you a better chance of making informed decisions and ensuring that your investments are truly aligned with your long-term goals. Buffett himself has said, "Diversification is protection against ignorance." What he means by this is that diversifying your investments too widely can often be a sign that you don't fully understand the companies you're investing in. When you spread your money across hundreds of stocks, you're less likely to have the intimate knowledge of each business that allows you to make confident decisions. For Buffett, the key to success is to focus on a small number of companies that you know inside and out, and that you believe will generate strong returns over the long term. But that doesn't mean Buffett avoids risk altogether. In fact, his investments are often in companies that have significant growth potential, and he's not afraid to put a substantial portion of his wealth into a single business. However, the difference is that he's extremely selective about the businesses he invests in. He doesn't just go for anything that seems promising. He looks for businesses with a clear competitive advantage, a strong management team, and predictable, sustainable earnings. By focusing on these high-quality businesses, he's able to minimize the overall risk in his portfolio while maximizing the potential for long-term gains. One example of Buffett's approach to focus is his investment in Apple. While many investors were skeptical about Apple's stock due to its heavy reliance on a single product, the iPhone Buffett saw the company's strong brand, customer loyalty, and massive cash flow as reasons to focus a significant portion of his portfolio on Apple. Over time, Apple has become one of the most successful investments in Berkshire Hathaway's history. Buffett's decision to concentrate on a smaller number of high-quality companies has allowed him to earn greater returns than if he had spread his investments across a broader range of stocks. Contrast this with a more traditional approach to diversification, where an investor might have their money spread across a large number of stocks, bonds, real estate, and other assets. While diversification can reduce individual risk, it also dilutes potential returns. The idea is that you're spreading your money so thinly that you may not see the kind of outsized gains that come from investing heavily in a few truly great companies. Buffett's strategy is a calculated form of risk-taking. He's willing to take a larger risk on a few businesses that he knows intimately because he believes those businesses have the potential to significantly outperform the market. But focus doesn't just mean investing in fewer companies, it also means maintaining a narrow investment strategy. Buffett avoids complex, speculative assets like cryptocurrencies, startups, or high-tech ventures that are outside of his circle of competence. Instead, he focuses on traditional industries with strong fundamentals, things like consumer goods, insurance, and even railroads. By sticking to what he knows, he can focus his attention on a few areas where he has an advantage over the average investor. This is the essence of his focus strategy, concentrating on what you understand best. The power of focus also extends to the management of investments. Buffett doesn't constantly shuffle his portfolio in search of better returns. Instead, he invests in companies with strong leadership and a clear path forward, and he lets them operate independently. He said that he likes to buy companies that he doesn't need to micromanage, companies where he trusts the management team to continue executing the business model successfully. By focusing on businesses with strong management teams, Buffett has freed himself from the constant need to intervene, allowing his investments to grow on their own over time. Now, focus doesn't come without its challenges. Concentrating your investments in a few companies can be nerve-wracking, especially when those companies face short-term turbulence or market fluctuations. The temptation to sell and diversify can be strong, especially when the market is volatile. But Buffett's strategy is about maintaining conviction, sticking with the companies you believe in. Even when the short-term results aren't perfect, he's confident in the businesses he invests in and is willing to ride out the market's ups and downs, knowing that the long-term growth will eventually materialize. So, how can you apply Buffett's principle of focus to your own investment strategy? First and foremost, it's about quality over quantity. Don't spread yourself thin across dozens of assets. Instead, concentrate your efforts on a small number of investments that you believe have the potential for strong long-term growth. This doesn't mean putting all your eggs in one basket. It means concentrating on the best baskets, the ones that align with your skills, knowledge, and understanding. The second part of the equation is depth of understanding. To make the most of your focused investments, you need to truly understand the businesses you invest in. This means going beyond just the surface-level financials and digging into the company's products, markets, competitive landscape, and management team. The more you know about the companies you invest in, the more confidence you'll have to hold on to them for the long term, even when the market is volatile. Lastly, focus means sticking to your circle of competence. Don't try to chase the next big trend or invest in industries you don't understand. Instead, concentrate on areas where you have knowledge and insight. The best investments are often in industries you already understand well, rather than those that seem exciting but are outside your expertise. Historians still debate the effectiveness of Buffett's focus strategy, particularly when compared to the more traditional advice of diversification. But regardless of the debate, it's undeniable that Buffett's concentrated approach has delivered exceptional results. By focusing on a small number of quality investments, Buffett has been able to build his fortune and continue growing it over decades. As you consider your own investment strategy, think about where you can apply the power of focus. Concentrate on businesses you know and believe in, and give yourself the time to understand them deeply. You'll find that this approach will give you a much greater chance of long-term success than trying to diversify and manage a massive portfolio. As we continue exploring Warren Buffett's approach to investing, we now come to a critical concept that has shaped his strategy for decades: Buffett's unique philosophy on risk. Most investors shy away from risk. often seeking to minimize it as much as possible through diversification, hedging, or complex strategies. But Buffett's view on risk is different. Instead of avoiding it, he embraces a more calculated, intelligent form of risk-taking, one that focuses on understanding, managing, and mitigating risk, rather than trying to escape it entirely. The first step in understanding Buffett's philosophy on risk is realizing that not all risk is created equal. Many investors define risk simply as the possibility of losing money. But for Buffett, risk is more about the likelihood of not achieving a desired outcome. In his words, risk comes from not knowing what you're doing. This distinction is crucial. For Buffett, the real risk lies in making investments without understanding the business or its underlying fundamentals. If you can't evaluate the company's financial health, growth prospects, or competitive advantages, then you're exposing yourself to unnecessary risk. On the other hand, if you thoroughly understand the business and have confidence in its long-term viability, the risk is manageable, even if there's some short-term volatility. Buffett also believes that investing in great businesses with a strong margin of safety can significantly reduce risk. By buying businesses that are undervalued relative to their true worth, you're essentially purchasing insurance against downside risk. The margin of safety acts as a cushion, helping protect your investment even if things don't go as planned. This is where Buffett's strategy differs from those who aim to minimize risk through diversification. Instead of buying a broad array of stocks to spread risk, Buffett focuses on purchasing a small number of fundamentally strong companies at a discount. This approach allows him to take on less risk because he's only investing in businesses he understands and believes in. An example of this approach can be seen in Berkshire Hathaway's investment in GEICO. Buffett famously purchased GEICO in the 1970s when the company's stock was trading at a low price due to temporary market conditions. The company had solid fundamentals, a reliable business model, and strong growth prospects, but the market had irrationally discounted its value. Buffett saw this as an opportunity to invest with a significant margin of safety, knowing that the company's true worth would eventually be recognized. This is a perfect example of how Buffett uses his understanding of a company's fundamentals to mitigate risk, rather than relying on diversification or speculative bets. But Buffett's approach to risk doesn't mean he's immune to making mistakes. He's made his share of bad investments over the years, and he's the first to admit that not every decision has paid off. However, his philosophy is that a few mistakes are acceptable as long as they don't jeopardize the overall portfolio. He said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." This is a crucial part of his risk philosophy. Rather than trying to avoid mistakes altogether, Buffett focuses on minimizing their impact by investing in businesses with strong fundamentals and a substantial margin of safety. By making smart, well-researched decisions, he reduces the likelihood of significant losses. Buffett's approach also emphasizes the importance of long-term thinking as a way to mitigate risk. The longer you hold on to an investment, the less likely you are to be affected by short-term market fluctuations. Short-term volatility can cause significant price swings in a company's stock. But if you're focused on the long-term health of the business, these fluctuations become less relevant. Over time, the company's true value is more likely to be reflected in its stock price. By holding on to investments for the long haul, Buffett allows the business to grow and compound, reducing the impact of short-term risk factors. For many investors, managing risk involves balancing a portfolio of different assets, from stocks to bonds to real estate. But for Buffett, the best way to manage risk is to stick to what you know. By staying within your circle of competence and only investing in businesses you truly understand, you significantly reduce the chances of making risky decisions based on incomplete or incorrect information. Instead of taking on speculative investments, Buffett focuses on companies with predictable earnings, strong management, and a sustainable competitive advantage. This approach minimizes the risk of investing in a company that might be subject to sudden disruptions or unforeseen challenges. Buffett has also emphasized the importance of investing in businesses with a durable competitive advantage, a moat. A company with a strong moat is one that has a significant barrier to entry, such as brand loyalty, economies of scale, or intellectual property. This makes the company less vulnerable to competition and external threats. thereby reducing the risk of investing in it. When Buffett invests in companies with a strong moat, he's essentially investing in businesses that can weather storms over the long term, even when market conditions change. By focusing on these types of businesses, he's able to significantly reduce the risk of losing money. But despite his focus on managing risk, Buffett is not afraid to take calculated risks when the opportunity arises. One of his most famous investments was in the Washington Post, which he bought in 1973. At the time, the company was facing significant challenges, including high debt levels and a struggling newspaper industry. However, Buffett saw an opportunity to invest in a business with a strong brand and a clear competitive advantage. While the investment carried some risk, Buffett believed the company's potential outweighed the short-term challenges. Over time, this bet paid off handsomely, as the Washington Post grew into one of the most successful media companies in the world. This is an example of how Buffett is willing to take on calculated risks, not reckless ones, but only when he believes the long-term potential of the business is undeniable. Historians still debate whether Buffett's ability to manage risk is what sets him apart from other investors, or if it's simply his ability to identify undervalued companies with strong fundamentals. Regardless of the answer, it's clear that his risk philosophy has been one of the key drivers of his success. By focusing on businesses with strong management, a competitive moat, and a margin of safety, Buffett has been able to minimize risk while maximizing potential returns. For anyone looking to replicate Buffett's success, the key takeaway is simple: don't avoid risk altogether, but manage it intelligently. Understand the businesses you invest in, buy them at a price that provides a margin of safety, and hold on to them for the long term. By doing so, you can reduce the likelihood of significant losses and increase your chances of long-term success. Let's continue our journey by examining another fundamental aspect of Warren Buffett's investment philosophy: the business moat. If you've been following closely, you'll realize that Buffett's investment strategy isn't just about buying companies that look good on paper. He's also deeply concerned with the concept of a company's competitive advantage, what he refers to as its moat. The moat is the barrier that protects a business from the competition and allows it to continue generating profits over the long term. Without a strong moat, even a great company can be overtaken by rivals, and its profitability can erode. Buffett often says that the strongest companies are the ones that possess a wide moat, or a sustainable competitive advantage that is difficult for competitors to replicate. This advantage could come from various sources: brand strength, cost advantages, economies of scale, or technological innovation. A business with a strong moat is one that can fend off competitors and maintain its profitability. Even in challenging market conditions, a wide moat makes it difficult for new entrants to challenge the business, ensuring that it continues to generate returns for its investors year after year. Think of Coca-Cola. For example, the company's moat isn't just its ability to sell a sugary beverage. It's the brand loyalty and global recognition that Coca-Cola has built over the decades. The Coca-Cola brand is one of the most valuable in the world, and its customers consistently choose it over competitors. Even if new competitors enter the market with similar products, Coca-Cola's massive distribution network and established reputation allow it to maintain its dominance. This is the essence of a moat, a competitive advantage that provides long-term protection against competition. Buffett has been known to seek out businesses with wide moats because they offer predictable, sustainable profits. A business with a moat doesn't just have a competitive advantage in the short term, it has a barrier that will protect it for years to come. The more secure the moat, the more likely it is that the company will continue to generate profits over the long term, which in turn ensures a steady stream of returns for investors. But not every business has a moat, and it's essential for investors to identify whether a business has a competitive advantage before investing. Buffett often talks about the importance of doing thorough research before buying into any business. If the business lacks a moat, it will be vulnerable to competition and market changes, making it a risky investment. A company without a moat is one that might experience profit fluctuations, shrinking market share, and, ultimately, a decline in its long-term value. This is where Buffett's value investing strategy comes into play. He focuses on businesses with clear, tangible advantages that can defend their market positions against competitors. These businesses are usually less volatile because they have sustainable advantages that make them more resilient during economic downturns. For example, companies that dominate essential industries, like railroads or utilities, have built-in moats because they operate in sectors with high barriers to entry. Similarly, consumer goods companies like Procter & Gamble have built-in moats because of their established brands and customer loyalty. Buffett's investment in American Express is another great example of his focus on the moat. When he invested in American Express, it was not just because of its financial performance at the time, it was because of its brand strength and the trust it had built with customers. People trusted American Express for its premium service and rewards program, and its ability to protect its position in the financial services industry was a key part of Buffett's investment decision. While having a moat is essential for a company's long-term success, Buffett also recognizes that not all moats are created equal. Some moats are more durable than others. For example, a technological moat, based on cutting-edge innovation or intellectual property, can provide a competitive advantage in the short term, but it can also be vulnerable to disruption. For instance, companies in the technology sector often face intense competition from new startups, and their innovative edge can be overtaken as quickly as it's established. Buffett tends to be more cautious about these types of moats and prefers companies with less volatile, more stable advantages like Coca-Cola's brand strength or the network effects that companies like Visa and MasterCard enjoy. Buffett's strategy is to look for companies with stable and sustainable competitive advantages that aren't easily replicated. He looks for businesses that have pricing power, the ability to raise prices without losing customers, and that can generate profits even when market conditions are difficult. These types of businesses are more likely to withstand economic fluctuations and come out ahead in the long run. As an investor, how can you apply Buffett's concept of the moat to your own strategy? First, it's important to assess the competitive advantage of any company you're considering. Does the company have a strong brand, a unique product, or some other form of differentiation that gives it an edge over competitors? Look for businesses that are not only dominant in their industry, but have a long-term position that is difficult for competitors to challenge. Pay attention to how the company defends its market share and whether its moat is likely to persist for the foreseeable future. Second, consider the stability of the moat. Some businesses may have temporary advantages, but those advantages can erode over time. Think about whether the company is in a position to maintain its dominance in the long term. A company with a strong, wide moat is one that is built to last, and it's the type of business Buffett looks for when making his investments. Finally, remember that a strong moat isn't just about having competitive advantages. Today, it's about the future. Consider whether the company has the right management in place to adapt and evolve its moat as the market changes. Buffett always emphasizes the importance of great management in maintaining a company's competitive edge. Even businesses with strong moats can falter if their leadership doesn't keep up with the times. Historians still debate how much the concept of a moat is rooted in Buffett's personal philosophy versus traditional investment principles. But what's clear is that Buffett has used the concept of a moat to successfully guide his investment decisions for decades. By focusing on businesses with strong, sustainable competitive advantages, Buffett has been able to achieve long-term success while minimizing risk. So, as you look at potential investments, ask yourself, does this company have a moat? If the answer is yes, you may have found an investment that can stand the test of time. As we explore Warren Buffett's investment philosophy further, let's now focus on an essential component of his strategy: learning from mistakes. The very idea that an investor can avoid mistakes is a fallacy, as no one, including Buffett, has an error-free track record. In fact, Buffett is one of the first to admit that he's made his share of mistakes throughout his career. However, the secret to his enduring success is not avoiding mistakes altogether, but learning from them and using those lessons to refine his approach. This aspect of his philosophy is a powerful reminder that failure isn't something to be feared. Rather, it's something to embrace and learn from. Buffett's ability to reflect on his missteps and adjust accordingly is one of the key reasons he has been able to sustain his success over such a long period. When he makes a mistake, he doesn't shy away from it. He acknowledges it, learns from it, and moves forward with greater insight and understanding. This willingness to face his failures head-on is what differentiates Buffett from many other investors, who often try to hide or ignore their mistakes. Let's take a look at a couple of examples where Buffett himself has admitted to mistakes and how those missteps have helped shape his investment strategy. One of his most well-known mistakes was his investment in Dexter Shoe Company in the early 1990s. At the time, Buffett thought that Dexter's strong brand and distribution network made it a solid investment. However, what he overlooked was the rapidly changing landscape of the footwear industry, particularly the rise of lower-cost imports. As a result, Dexter's market position weakened, and Buffett eventually sold the company for a fraction of what he had paid for it. Buffett has been very open about this mistake, and he's used it as a learning experience. The lesson he learned from Dexter was the importance of understanding long-term industry trends and competitive forces that could undermine a company's market position. This insight has influenced the way he evaluates future investments, focusing on companies with not only strong fundamentals, but also sustainable business models that are resistant to changing market conditions. Another example of Buffett's willingness to learn from mistakes is his experience with Tesco, a British supermarket chain in which he invested in the mid-2000s. While Buffett initially believed that Tesco had the right strategy and market position, he later admitted that the company's management had failed to properly execute its plans. Tesco faced significant challenges, including expansion problems and accounting issues, which ultimately caused the stock to underperform. Buffett has acknowledged that he underestimated the risks involved with this investment and that he should have done more to understand the internal management challenges before pulling the trigger. The lesson from Tesco was clear. Management quality is paramount. Even a great business model can falter if it's not led by a competent team. This realization has had a profound impact on Buffett's approach to investing and management. Since then, he has become even more meticulous about evaluating the track record of leadership in the companies he invests in, ensuring that they have the necessary skills and integrity to execute the company's strategy. What makes Buffett unique, however, is not just his ability to learn from mistakes, it's his willingness to own them. Unlike many other investors who might try to cover up or downplay their failures, Buffett openly discusses his errors and uses them as opportunities to improve. This transparency and humility have earned him the respect of not only investors, but also business leaders around the world. But the learning process isn't just about acknowledging mistakes, it's also about adapting and improving. Buffett continually refines his investment strategy based on the lessons he's learned from past errors. His willingness to evolve is one of the key reasons he's been able to achieve long-term success. For example, while he used to invest in smaller companies and try to help turn them around, he eventually pivoted to investing in large, established companies with proven business models. This shift allowed him to scale his wealth more effectively and focus on businesses that required less day-to-day management, allowing him more time to focus on the big picture. Buffett's learning process extends beyond just investing mistakes. It includes the lessons he's learned about human nature, market psychology, and the importance of patience. One of the greatest lessons he's shared is that you can't predict market movements or control how the world works. While many investors obsess over predicting the future, Buffett's success has come from focusing on what he can control: the quality of the businesses he invests in, the price he pays for them, and his willingness to hold on to them for the long term. This ability to learn from mistakes also ties into his commitment to lifelong learning. Buffett spends a significant amount of his time reading, whether it's financial reports, business books, or news articles. His appetite for learning is insatiable, and he continues to improve his understanding of the world's markets, industries, and companies by constantly learning and evolving. Buffett stays ahead of the curve, making his mistakes less costly over time and allowing him to grow as an investor. One key takeaway here is that mistakes are inevitable, but they don't have to be debilitating. What matters is how you respond to them. If you're willing to learn from your missteps, you can turn them into opportunities for growth. The same applies to investing. Nobody is perfect, but by acknowledging your errors, understanding the underlying causes, and applying those lessons to future decisions, you can improve your chances of success. Buffett's openness about his mistakes provides a valuable lesson for all investors. Perfection isn't the goal, improvement is, as long as you learn from each mistake and apply that knowledge to future decisions. You're on the path to becoming a more effective investor. Over time, those small improvements compound just like any other form of investing, and they can have a significant impact on your long-term success. So, as you build your investment strategy, remember that mistakes aren't the end of the world. Embrace them as learning opportunities, and use the lessons you've gained to improve your decision-making going forward. In the end, it's the ability to adapt and refine your approach that will determine your success. As we approach the end of our exploration into Warren Buffett's investment philosophy, let's close with an essential yet often overlooked concept: the wisdom of simplicity and consistency. Throughout his legendary career, Buffett has demonstrated that sticking to simple, proven strategies and staying consistent with them over time is often the most effective route to wealth creation. In a world obsessed with complexity, Buffett's focus on the basics has not only been his greatest strength, but has also allowed him to achieve extraordinary success. Let's dive into why simplicity and consistency are at the heart of Buffett's approach. One of the most remarkable things about Buffett's investment style is that it's built on incredibly simple principles. As we've seen throughout this journey, Buffett doesn't rely on complex financial models or speculative market predictions. Instead, he focuses on understanding businesses, evaluating their long-term potential, and buying them at a fair price. He doesn't get distracted by short-term noise, market trends, or hype. His strategy is about finding good businesses, holding them for the long haul, and letting them grow over time. It's as simple as that. Buffett's love for simplicity can be seen in his famous quote, "The business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective." In many ways, this quote encapsulates Buffett's entire approach to investing. While the financial world often gets bogged down in jargon and intricate formulas, Buffett has always maintained that success in investing comes from keeping things simple. The more complex you make your strategy, the more room there is for error, uncertainty, and unforeseen risks. But simplicity doesn't mean a lack of rigor. Far from it. Simplicity is about focusing on what matters most: the fundamentals of a business, instead of getting distracted by the latest financial trends or chasing after fleeting opportunities. Buffett focuses on the core aspects that determine a company's value: its management, its competitive advantage, its profitability, and its potential for growth. He doesn't waste time on the complexities that others get bogged down by. Instead, he applies simple, clear metrics to evaluate whether an investment is worth pursuing. In fact, simplicity is also reflected in Buffett's personal life. While many billionaires chase after the latest luxury or new trend, Buffett has consistently maintained a humble lifestyle. He lives in the same house he bought decades ago, drives a modest car, and keeps a relatively low profile. For him, the key to happiness and success isn't about acquiring wealth for the sake of acquiring wealth. It's about sticking to simple values and making good decisions over time. This emphasis on simplicity and consistency is a core part of his philosophy, both in investing and in life. But simplicity also means consistency. One of Buffett's greatest strengths is his ability to stay consistent with his investment principles. Even when the market is tempting him to act otherwise, there are countless examples of market panics, bubbles, and recessions throughout Buffett's career. But through it all, he has stayed remarkably steady and committed to his approach. He doesn't chase after short-term gains, and he doesn't get caught up in market frenzies. Instead, he stays focused on buying businesses that he understands, and he holds on to them for the long run. In fact, consistency is one of the most important principles in Buffett's philosophy. While many investors jump from one trend to another, Buffett sticks with his tried-and-true methods. He doesn't try to outsmart the market with predictions or complex algorithms. He simply applies the same investment principles over and over again, and lets the results speak for themselves. This consistency has paid off immensely over time, as Buffett's investments have compounded and grown steadily, without the dramatic fluctuations that often come with chasing after the next big thing. Another aspect of simplicity and consistency in Buffett's approach is his focus on a limited number of investments. As we've seen, he doesn't believe in spreading his money across hundreds of stocks. Instead, he focuses on a handful of high-quality businesses that he believes will perform well over time. By concentrating his investments, he can keep a close eye on the companies he owns and make more informed, deliberate decisions. This consistent focus on a small number of companies has allowed him to build substantial wealth, while others are spread thin across countless investments. And let's not forget that Buffett's consistent long-term vision is rooted in his belief in the power of compounding. By consistently reinvesting his profits and focusing on businesses that grow steadily, Buffett has allowed his wealth to compound at an extraordinary rate. This is the magic of consistency. It's not about making huge, flashy moves, but about staying true to your principles and letting your investments grow over time. Historians and analysts alike often wonder about the secret behind Buffett's success. Some argue it's his ability to find undervalued companies, while others point to his deep understanding of business and management. But the truth is, the key to his success is not just his knowledge or instincts, it's his commitment to simplicity and consistency. By sticking to the basics and staying disciplined in his approach, Buffett has been able to build one of the most successful investing careers in history. For those looking to replicate Buffett's success, the lesson is clear. Don't overcomplicate things. Stick to simple, time-tested principles and stay consistent in your approach. The key to success in investing isn't about outsmarting the market. It's about understanding businesses, investing in what you know, and having the patience to wait for the long-term rewards. If you can do that, you'll set yourself up for success. As we wrap up this journey, remember that unsimplicity is the ultimate sophistication, not just in investing, but in life. By focusing on what truly matters, staying consistent, and sticking to your principles, you can achieve great things. And who knows, maybe one day you'll find yourself reflecting on the simple wisdom that has guided Warren Buffett to become one of the greatest investors of all time.